All right. So we're going to cover a few things, mostly investor related. I'm going to touch on FHA 203K for a minute just so you can get your creative minds going and look at what's potential to come. So we'll be covering some renovation loan options, DSCR loans. It's a DSCR loan. Don't you know what a DSCR loan is, Patrick?
If I was a lender, maybe I would.
Anybody know what DSCR stands for?
Debt service coverage ratio.
Exactly. Star pupil right there. Come on, Patrick.
He's your number
Do
one.
better. Do better. So what that means, okay, that just explains the acronym. What that means is as long as the home will rent for, they like to see it rent for more than what your mortgage expense is. And if you had usually 20% down and a decent credit score, they will loan just on that. You don't have to provide any income or anything. It's just, do you have money? Do you have credit? Will it rent for more than what your mortgage is? We will fund you, okay? But we'll dive into that when we get there. And then we're going to talk about our all-in-one. That is a massive tool, especially for investors, and we'll dive into that as well. But like I said, wanted to touch on 203K standard, the FHA renovation product, even though it's not an investment loan because it's FHA. All right, this is creative. We're getting creative. There's two sides of this. There's a standard 203K, right, which is more complicated. And then there's a limited 203K. The biggest difference between the two is limited, which they just upped the limit this year. It used to be $35,000 max in renovations. Now you can do up to $75,000 in renovations on the limited. Okay.
I'll get my hat back then.
Right. But you can go limited, doing a bathroom or a kitchen, all the way to leveling most of the house to do a standard. Okay. As long as it's potentially can appraise for that, but we'll touch on that. So on the 203K standard, they ask for $5,000 in eligible improvements minimum. You will need to get a HUD consultant on the standard because it's going to be bigger than $75,000 usually as far as the repairs and renovations. So they want a HUD consultant to be involved.
Who assigns a HUD consultant?
There's a list of them, and they're all standardized pricing, so one can't charge more than the other. Okay, so there's a list of them. You choose. Here's the key thing. The most creative part of this entire loan is when we go to FHA 203K, we're allowed to take advantage of 110% of the appraised value. All right? So, if the appraised value comes in at $400, our loan amount could be up to $440. Okay? This is a loophole that we can use when the shift in pricing comes and it goes faster than the appraisers can keep up with. We see it all the time. It's a cycle. As soon as the inventory shrinks, homes start jumping up in pricing and the appraisers aren't keeping up, or they just don't want to keep up. And they're just going to appraise it under every time. So we can take that. I'm going to give you a little cheat when we get to the limited. But amount of time to be done on a standard, you get 12 months to complete all the renovations. Okay? This is just an FHA loan. As far as you guys as agents are concerned, it's just a loan, right? It closes. And then we take care of servicing all of the repairs, right? Kind of like a holdback on steroids. So what happens is it takes a little longer up front sometimes, right? It could take 30 days if we got our stuff together, but we need to get all the bids. We have to get the bids for everything you're doing from the contractors. Standard, if it's over $75,000, we're going to need licensed contractors, right? You're not going to be able to just have Joe Schmo do it, handyman guy do it. They're going to have to be licensed and approved. But we have to have all those bids because when the appraiser goes out, he's going to have those. He's going to take the bids. He's going to appraise the house. This can be used if if we know we need to fix windows, if we know we need to repaint the house, if we know we need to do things on FHA to get it to fund, we can do it as a 203K and say, we're going to do all those things, go ahead and fund the loan, and then we'll 203K it and dump $15,000 into paint, repair, roof, or whatever the appraiser would have called out on an FHA loan. So we can do that.
So for this loan, they're purchasing a home that wouldn't qualify for FHA.
Mhm.
However, using this 203K, you're saying, we're gonna give you the mulligan because we know you're gonna do these repairs.
Yeah. I'll give you an example. I did one when I was licensed in Alaska. I did one in Alaska. It was foreclosed. Foreclosed home, frozen. Water was on, it was dead of winter, below 40 degrees, the entire house was frozen. Boiler was frozen up. All the piping from the garage halfway into the house was frozen. Technically, VA doesn't want you to just do a renovation loan just to repair things. So what we did was, we're going to do a bathroom. We're going to remodel the bathroom, which just happens to include most of the piping that was frozen. So they approved it. So he got a foreclosed, frozen house for way below market value. We gave him all the money to do all the repairs. So he got a bathroom and a home under value, and the appraiser goes out, praises it as it is, doesn't count that it's frozen or anything, right? And praises what it'll be with the bathroom. So he gets his foreclosure at $250. It's normally worth $375 out the door. Adds another $25,000 in repairs. This thing still appraises. So he gets $275 as the loan amount. It appraises for over $400,000. Okay, so we can use this as a tool on the FHA side.
Do you have to stick with just what the repairs are, or can you upgrade things?
You can do more. You can do more. It just has to have a minimum of what's done, because the appraiser is only going to say what it will appraise for based on the bids he has in hand. Okay?
So if you do more, he could come back and it could appraise even higher.
Right. Could. It could. So, like I said, it's just a normal transaction. You're going to close in 30 to 45 days and you're going to walk away. Unless it's your friend, they'll keep sending you pictures of all the renovations. All right? We take care of the rest. We fund all the project, and when it's ready, the appraiser goes back out, confirms that everything was done, looks good, here it hits value. He's not going to come out and say, I kind of screwed up. Actually, it's not worth this much, even though you did all this. No, that's all up front. He says it's here, and it's going to be here based on this stack of information.
What if the market is dropping?
That's a good question. I haven't had this situation yet,
Right.
but that is a very good question. But we're talking about nine months on an FHA to be done, 12 months on the conventional side to be done. How much can it drop in 9 months? We're talking catastrophic. We know we've seen it happen. Hopefully that never happens again.
2009, I don't know.
So this is what can be done on FHA. Focus on the ineligible stuff. Okay? You can't do pools. You can't do luxury items. You can't do gazebos. That doesn't count on the FHA 203K. All right, but what you can do, you can repair or remove a pool, right? You just can't do a new pool. Cool decking, we can call that a repair. Replaster, we can call that a repair. New equipment, we can call that a repair. But you just can't put one in. Repairing, reconstructing, or elevating an existing foundation where the structure will not be demolished. Okay? So we can raise the foundation. Reconstructing a structure that has been or will be demolished. All right? Here's the key difference between conventional and FHA. You can demolish the whole structure, but you have to use the foundation. You can't add to the foundation and build up. Has to stick to that. Conventional, you have to leave one wall. That doesn't look really weird, but there has to be at least one wall. So FHA has the limited, and here's your just to give you an idea of what a HUD consultant would charge based on if you're over $100,000 in renovations, they're going to charge $1,000 to be the consultant on it. Okay. This is going to be your most used piece in the future. When we talk about 110% after completion, the appraisal. let's say the home, it's going to happen. Promise me it's going to happen. Maybe 18 months to 24 months down the road when the inventory starts filtering through and we start decreasing. Home, multiple bids, over asking, was listed at 300. They come in at 320. Appraisal comes in at 300. Okay? Savvy lender is going to say, we're going to flip this to 203K. Why? It's like, they need a refrigerator. So we're going to throw a $5,000 refrigerator. Like, we're super, how much are refrigerators these days?
$5,000.
Are they?
Yeah.
Even with the one with the cool screen that talks to you and orders food for you? Jeez. Okay, so we're going to throw a $5,000 refrigerator in there. Limited. FHA 203K because it's only $5,000. All right? But because we shifted it to 203K, now we can loan up to 330. Even though it appraised for 300, we can take advantage of that 110% and we can close that loan without the seller coming down off of appraised value, without the buyer coming in with extra money. Shoot, the buyer's getting a freaking fridge out of it. Not only did it appraise low, but he's getting a fridge.
Who has to buy the fridge? That would be on
The buyer can.
Yeah.
Yep. So all they have to do is show the invoice and take a picture and good to go. So that's an advantage. Another thing, solar. Anything that's energy efficient. So solar does not count towards this 110%. So we can do up to $30,000 in repairs to get it to 330, and do $30,000 in solar, and still do it. So if I'm thinking about doing solar on a house, and I'm going to go buy a house, I'm just going to do a 203K loan, just so I can roll a roof, solar, whatever energy efficient stuff I want to tack onto that, all into the loan at 100%. Now I don't have a solar payment, but it's paid for. I don't have a lease because I paid for it. It's in the loan. And they have, so you could rack that sucker up to $375,000 loan amount on a $300,000 appraised house. And we can still close the deal. Because the solar doesn't count when we're looking at it. Because we're not expecting the appraiser to appraise the solar or give us a value on it. If the solar costs $50,000, right? We could be up to $380,000 and still have an original appraisal at $300,000. You following me? It's a total loophole that we can use when we get to that situation. Or if someone's talking about, yeah, I want a house, I'm going to put solar, definitely look at this. Because then you don't have to go do a company and sign some lease or do that. They can go to a company, it's like, how much it costs? No, I want to buy it. 45, perfect, sign me up. Let's throw it on a loan.
No
So,
escalation cost.
none. Under 75,000, you can hire Joe Schmo handyman. You can hire family. They just don't want you doing it yourself. When you get to conventional, they'll let you do that kind of stuff yourself. They're a little easy. They ease up a little bit. So yeah, let's get to conventional. This is the one where investors can take advantage of. All right, investors can do a rental loan on conventional. Again, purchase at least 15% down. We can do refinances. We can do a refinance reno, right? So even if you own the home and you want to do things, let's say now that we're in conventional, let's say we want to add a pool. We can refinance a house if the rate's not 2%. We can refinance a house and put in your pool, throw in a kitchen, anything else you want, as long as it'll appraise. Same situation, appraiser comes out, takes a look at the house, takes a look at what you're doing. Yes, it appraises. Go ahead, sign, close, funds are paid to whoever's doing all the work. So you can do the refinance. Investments, 1 units. I know there is a. All right. As a primary residence, it allows you to buy a fourplex on a rental loan, as long as you're going to live in one. It won't let investors buy a fourplex on a rental loan. Don't know why, but max units for the investor is 1 unit. Streamline, again, they have the limit, which now they call Streamline Unconventional. Anything under 35,000 or less, no consultant required. These ones can be done by you. If it's Streamline and Conventional, you can do all these repairs yourself. If it's over that, oh, sorry, someone wants to take a picture. If it's over that, then you have to get the consultant and you have to get someone that's licensed. Could be a handyman, but the vetting process for your builders or contractors is a lot more laxed on the conventional side. You don't, FHA wants a massive track record and, you know, referrals and all that stuff to get a builder for that standard 203K. ADU, outbuildings, you can use this renovation loan to create a, you know, mother-in-law suite, attached or detached. Swimming pools, you could do a gazebo by the swimming pool, you could do a pool house. Really conventional part is wide open. Gave you a renovation comparison sheet there. So that pretty much breaks down whether it's you know, owner-occupied, second home investment, availability. You'll see that Streamline does not allow investors, only owner-occupied and second homes. When we talk about second homes and investments, the rates are similar. So it just depends on the structure and the qualification, whether we need more income or whether we want to just, if we don't need the income and we want to call it a second home so we can get to the Streamline and take advantage, we'll handle all of that. We'll discuss with them and see how best to structure that. So, but what the main things that you need to take out of this is that the renovation can be another tool for an investor, right? Or usually for the first-time investor who doesn't have a lot of money and wants to buy a house and do all the renovations, roll it all into loan, okay? DSCR. All right, so we talk about DSCR. The things that affect the DSCR the most is going to be credit, number one, your down payment, and then the actual ratio. So the ratio of what will this home rent for versus what will the mortgage be. And I will pull up a calculator and show you just so you can get an idea of there. Just so you can get an idea. And these can be done with foreign nationals. Someone comes to me and it's like, I have someone that lives in the Philippines, but they want to buy a house here. Cool. We can do a DSCR. They're like, well, they don't have any credit. Cool. I just need a letter from their trade lines there. They're not going to have social security numbers, but they do have credit accounts in these other places. Canada, everyone does credit differently. So if I'm in the Philippines and I have a credit line in the Philippines, all I need is a letter from that credit line stating I'm in good standing, how long I've been, you know, a customer and all that stuff. Sound crazy?
Who is writing the letter? Issuing the
The credit line company. So Philippines National Credit or Philippines National Bank has your car or something. And I don't know how all that works in the foreign countries, how the loaning works, but whoever's loaning money, that institution will send a letter. So that's what we'd use for establishing any credit. But DSCR is the easiest way because, like I said, they don't care about income. They don't care about, they do care about assets. They're going to want to see that you have enough reserves in the bank, and reserves depend drastically on the actual deal, where we are in ratio. The better the ratio on the deal, the more wiggle room we have in everything else. So if we, ideally, perfect world, you want a 1.25 ratio, meaning that if the home's going to rent or your mortgage payment's going to be $2,000, you want that sucker to rent for $2,500. Okay, that would be ideal. Usually that takes more of a down payment. See how everything kind of works together? So here, let's say, so we got a U.S. citizen. This says no ratio, but if I put it to, let's 1.25. Oops, sign back in. Kind of give you guys an insight of how our normal days work and all the different games we get to play with all this stuff, trying to figure out how to get it. U.S. citizen, we'll go 1.25. Investment. All right, did you see how this FICO changed dramatically? When we had no ratio, meaning it was going to be 3/4 or less, or just not a good ratio, all of a sudden our minimum FICO went to 640. It was at 680 for the no ratio. Now we put in over 1.25. Now I can do someone with 640. Okay? LTV, we can go all the way to 80. Where was that on the no ratio there? So no ratio, LTV 75, meaning they need 25% down. So you see how that ratio really affects the game? So let's just put in a unicorn here. We'll go 1.25, right? Let's say they have 760, they got their stuff together, they're a great investor. And let's leave it at 25% down. Oops. Let's say that. The other thing that affects your rates is this prepayment penalty. Okay? Prepayment penalty is basically 3 months payment if you break, right? If we do a 5-year 5% fixed, meaning that if you break any time in 5 years, you have to pay the 5% prepayment penalty. But we could do a 5-year 5, 4, 3, 2, 1, which means it's prorated. So if you're there 3 years, you don't have to pay the full 5% or 2 years or whatnot. So it de-escalates your prepayment penalty the closer you get to 5 years in. All right. So if we did the 5, 4, 3, 2, 1, it gives us a rate of 6.875 and a credit of 1/8 of a point. If we did the 5-year fix, I think that was the same, wasn't it? Pricing might have been different. Nope, same. So I would not go with the 5-year fix. I'd just go for the 5, 4, 3, 2, 1. If we did a 2-year 2-1 prepayment penalty, basically as long as you got it for 2 years, it only went up 1/4 or 1/8, 6.875 to 6.99. I'd do that. If I didn't think I was going to hold it for longer than 2 years, I'd go ahead and pay the 6.99. That's a pretty phenomenal rate for not asking for any income documentation. So that's another way around some of these things where we got business owners who want to buy a house, but their tax returns show very little income. But as long as they have money in the bank and can put 20% down, we can still do it on a DSCR. Let's do this one. Let's do at least 3/4 ratio, and we'll do the bare minimums here just so you can get an idea of how much that affects the rate, because it's going to punch it. 75%, 60. Yeah. So we just went almost 1.5 points difference from where we were, just because the ratio went under 1. Still not the end of the world. 8.375 on an investment rate. It's not horrible, but there are ways to do better. So if you have someone that, let's say, because you guys are going to get people that go to the lender and say, oh, they won't approve me, I don't have enough income. But you know they do. Maybe they're a business owner. Their taxes are terrible. Hides everything. Have them come to us. We'll do a second opinion. we'll look at all of these different avenues, because if they can afford it, we got a product. Okay? I'm only touching on a few. These are the most used when it comes to investment. The DSCR, the renovation, and the one that I'm going to show you with the all-in-one.
Is there a maximum loan, max on that?
On this one, the max is 1.5 million. Sorry, you can't see. You're kind of off to the side. If I were to punch in a better ratio, though, it goes to 2 million. So the ratio affects how much they'll loan as well. Another thing, aspect that I found the hard way is that some of these DSCR lenders, some of our brokered out people, won't loan on a rural property.
On the what?
Rural property. Yeah. Most won't even do a cash out refi on a rural property. And we can do cash out refis on DSCRs too. Let's say they need money, we can do a cash out refi. Let's say they own it outright and it's a rental. They can pull money out, and if everything's beautiful, if they're like even 60%, they'll only pull 60%, their ratio is going to be 1.25. We might be able to get them a cash out refi under 7% on an investment property. That's intense. So lots of creative things. Now they can take that money and go buy another property. Okay? Just ways to create deals with your people.
So if you already have a property, and it's, say it's a conventional loan, could you go back, refi and do this
Yeah, if it's like your,
as a means to just purchase more property?
yeah, like I said, if you got a $500,000 investment that's paid off, and you want to go buy another like condo or something, pull $300,000 out on a DSCR. You didn't have to show any income. Sent a bank statement, did a credit report. There it is. Because on the cash refi, you don't have to put any money down either. You're just getting
What if
money.
it still has a mortgage on it?
We'll pay it off,
Yeah.
right?
Right.
So again, it comes down to the math problem. If they got a low rate on it, maybe they don't want to do it. But if they have to get money from somewhere, we have options. So, all right. Any other questions on scenarios on DSCR while we're on this? Nothing. Anybody had a client do a DSCR loan yet? Oh, you guys got to get out more. There's tons of potential then, right? So anybody done a renovation loan with a client? Yeah, there's so much potential. So much potential. Like this business is a blank check. The further you think outside the box, the busier you're going to be and the more deals you're going to do.
For how many years usually this loan?
That's 30-year loan.
30 years.
Yep.
Okay, what does it mean 1.21 on the top DSCR? It's the points they need to pay?
Where?
On the top.
On the top?
Uh-huh.
Oh, that's the ratio.
Between what they make here.
Okay.
Yeah.
The points is on
And
the right
points
side.
0.1.
Points, that's their discount point. Since it doesn't have a negative, that means that 7.25 rate is going to cost them an eighth.
And pre-penalty for 2 years, yeah?
Yes.
2-1, okay.
So you see all these different things can
Why did
affect.
they go to 7.25?
That went up to 7.25 because
It's on the 2 year.
we went from 2 year. Oh no, there was something else. Oh, because we jacked their credit down from 760 to 701. Yeah, it's wild. So we have to play this game on all these deals and move these things around to figure out the best pricing, get them qualified.
Okay, it's any difference between the states because it shows Arizona?
Yes. Let's try California. That was 7.25.
Uh-huh.
Okay, that one's the same.
Same.
Yeah. It will depend a lot on the actual type of home, condo, how many units. So this one's only saying 1 unit. Let's see. Oh. So if we do condo in California, it goes up a little bit. Went up an eighth.
What's the number in Nevada, the same?
Let's see here. Probably. Yep, same pricing. We did multi-unit, 4 units, 7.5. Not bad.
Is it way to finagle that to do on your primary home?
They do want to see, they expect this to be an investment property, like a rental. And most of the companies want to see rental history, like you've been in the business of renting homes before. There are ways to dance around that. But if you've never done any rentals, if you've never worked with investments, can say you were a property manager or anything like that, and you're just trying to do your primary residence, it's going to be an uphill battle finding the right one. Okay?
How many years ago rental history should be?
They just want to see at least 12 months. So like I said, even if you weren't a property owner, but let's say you were a property manager or you're in real estate, you could say, well, she's been assisting in leasing and acquiring clients and stuff like that, so she has experience in it.
Can you go higher than 4 units on a DSCR?
You can. 8 units is max.
Oh.
Now we're up to 9.75. Now not only would you go way high in pricing, but it's under 10. You get into the commercial world, it's a nightmare, right? And it's commercial wants 15. This is a 30.
So can you use that then to buy in a complex? Well, you weren't out here when that happened, but a lot of the apartment complexes, they got bought out, and then they turned them into condos and single-family residents, and they did that.
Yeah, so this is a non-QM product, so it doesn't require Fannie or Freddie approval to purchase. So as long as you're putting that 25% down, on which is probably the minimum on a condo, and it'll rent, right? They're going to do the appraisal on the rent and the value of the house. As long as those numbers add up, they don't care if it's sold.
So you could pick in a 20-building complex,
Yep.
you could pick 8 units and put it in that package.
Well, no.
No.
That's an 8-plex. When we're looking at that, it's like one building with 8 units. So you can't just pick and choose and call. Dude, I see what you're trying to do.
Yeah.
Right.
That's what I was
And like, I'm just going to pick which units I'm going to call it my 8-plex inside the
Well, get
60.
my down payment.
Okay. No, can't do that. All right.
What's the down payment on a 203K?
203K, it's just 3.5% down.
Still the
FHA.
same.
Yeah.
Got it.
So let's like go way outside of that. Let's say we're going to do a 4-plex FHA 203K, and let's say we want to renovate all 4 units, and it's going to cost us $400,000 to renovate. Well, you can qualify if FHA. You have to live in one, right? You can qualify for over $1 million with 3.5% down on an FHA 4-plex. So if I'm going out and buying a 4-plex, I'm going to do an FHA. It's easy, it's cheap, and later down the road when it's all renovated and I can get an appraisal in to show 30% loan or equity in there, then I'll shift it to a conventional and drop my rate or whatever. But FHA is the easiest for novice investors to get into it. So, but yeah, always 3.5% for FHA.
So it's the same down payment and the same credit?
Mm-hmm.
Okay.
Yep,
So
exactly.
it's the same that they
If we can approve them for a $400,000 loan amount with 3.5% down, and if the house was $300,000 and we're putting $100,000 in the renovation, it's 3.5% down on $400,000. If the solar was $30,000 of it, it's only 3.5% down on $370,000 because they don't count the solar. It's 100% financing. So
the only difference between this and a standard FHA, what is there, I mean, because they're not basing it off of.
oh, this is huge
Off
different
of
from.
income, so there's no, what is FHA, 50%, 49%?
I can get up to 56%
56%?
on the back end DTI,
56.
but usually about 42%
But this does not
maximum.
have that.
No,
Okay,
no, doesn't care about DTI because it
Right.
doesn't care about income.
right.
So you could have 200% DTI and still get a loan. So, all right, time to blow your mind. All right, so this loan is only with CMG EPiQ, right? We're the only ones that have this product. We broker it out to other lenders. So some people will have this, and they might call it something different, but we're the ones servicing, they're getting it from us. It's called all-in-one because it is a bank account, checking, debit, whatever, and mortgage all in one. It completely flips the mortgage on its head. What's the worst part about paying your mortgage after you purchase a home? What's the worst part about cutting that $3,000 a month check?
I'm out 3,000.
Gone. Evaporated. $18 towards principal. Yes.
Where'd you
Right?
get that deal? That's a smoking deal.
But they did this. That's called amortization. They did this back in the Depression. They went to an amortization model so that people can afford to buy a house. And they left it that way, and people are still doing it. They don't do it that way outside of the U.S. In fact, this is the type of loan that a lot of European countries is standard, okay? But when we talk about the amortization loan, they build in your payments fixed for 30 years, and this is how much goes to interest each month, period. Plain and simple. Now you can mess with it by sending principal-only payments or paying every 2 weeks or whatever. You can mess with it and shrink it. But the fact is you have a fixed payment for the next however many years. With this all-in-one, it's a fixed rate. No, it's not a fixed rate. It's a variable rate, okay? But it's a set amount, all right? And they take each night, it sweeps your account. Okay, so let me give you an example. Client says, I want the all-in-one loan. They refinance. Let's say it's a $500,000 home, and they have a $200,000 mortgage on it, all right? And they pull $400,000 out in a refinance. So we got $400,000 to work with. We pay off the $200,000 on the mortgage. We put the other $200,000 in the bank. So you have access to that $200,000, wire it, buy a car, buy a boat, whatever you want to do, okay? But that money's in your account. Let's say you get a commission tomorrow and you have direct deposit set up. $20,000 goes into that account. Tomorrow night, when it pulls interest, it sees $220,000 in principal. It's only calculating interest off of 180. All right? So then, a week later, your significant other's paycheck direct deposits for $5,000. Now they're taking even less interest. And the less interest they pull out each month, the more principal and money stays in. So it's technically a principal compounding loan versus an interest compounding loan. Cool thing is you get access to that money. Problem, double paying your mortgage on an amortized loan, you send $6,000 instead of $3,000 this month. Can you get that $3,000 back in 2 months? It's gone. On this, you decide to put $6,000 in instead of $3,000. Next week, Junior's got a freaking baseball Little League accident and has a cast, and you had to pay your deductible. You got it. And the money goes back in there when you're ready. It's a 30-year loan. So you have access to this money for 30 years. Now, after 10 years, because it has to operate like a 30-year, after 10 years, the money available, which we had $400,000, right? The money available decreases each year incrementally till we get to 30, and at year 30, it's zero. It's paid off, but you have access. If once it gets to 400,000, you have no payments, and it just sits there, available for use. Just closed one Friday for a guy in Utah. He built his house himself, $6.5 million. He had about $1.2 million left on liens to pay off. He gets a $3 million all-in-one refinance to pay off the $1.2 million, but put $1.8 million in the account so that he can go build specs. He no longer needs a bank. He is his own bank. He can go buy the lot, he can build the home, sell the home, money goes back in the account. So he's only out the interest for the days that he uses the money. So if it's a 6-month project, interest is doing this the whole time, boom, sells it, pays it back. There's no short term. If you did it any other way, you'd have to pay hard money. You have to pay on that money while it's out, which is probably going to be a lot higher interest than this. Closing costs every time you do one. So if you're a flipper or an investment who does his flips, this is the way to go, because now you don't have to rely on closing costs, paying points to hard money every time you want to do a project. You can have 2 of these loans in your name. So if you did it, you want to go with your highest assets so we can create the biggest credit line. Whether we're going to use all that money right away or not, we set it up to where that money's in the account and available. You guys following me? It's completely different. Let's take some questions before I jump into the simulator.
I have a question. So, the reason they're doing that is because when there's money in the account, they can do more loans off the cash?
Yeah.
Okay.
Yeah. So they can use that as down payments. Like he could take $200,000 of that money and go get a DSCR loan and use the $200,000 to put down. Okay? So you could do it that way. You can use that money for anything. And let's say you're an investor and you have 3 rental properties. And let's say you do this on your primary because it's your biggest credit line. What I would do is I'd set up all of those rents to direct deposit into the new account. So that and I'd use that as my working capital account, whatnot. So I pay all my taxes, pay all repairs, pay for services, all out of that account because all the rental money's coming in. And it's adding to the principal, which decreases your interest every day, right? So we did a simulation for someone in Utah. He was looking at refinancing from, I think he had a $140,000 loan, and he wanted to pay off all his student loans. So he was gonna need almost $400,000 total to pay off that loan and pay off the student loans. Based on the income he had coming in, we put all the income in the account, we subtract everything that would go out monthly in expenses. If he just did the basic simulation, that loan would be paid off in 3.7 years. Talking about a $400,000 loan. In 3.7 years, he'd have no payments and he'd have $400,000 sitting in an account to use. And he was planning on retiring in 3 years. He's like, I could push it to 4 for that. So that way when he retires, he has no payment, he has access to $400,000. As opposed to if he did a reverse mortgage, he'd pay astronomical fees just to get money out and not have a payment and have a depreciating asset because now the interest is taken away from his principal. Okay? So that would be a good option. I know you had a question. Yeah.
You said 30-year term?
Yep.
Do they have shorter terms on this?
Yeah, 3.7 years.
So that's the shortest
Yeah.
you can go.
Well, it could go 2 years depending on how fast you put the money in there. Here's an example. Cash buyers. Why dump all that cash into the asset? You know you're going to pull it out for something sometime, and when you're refinancing an investment property, you get hit with higher rates. So first, as soon as I got this product, I went right to the admins and I said, okay, I have a scenario because in southern Utah, there's a lot of cash buyers for second homes. Okay, so you're telling me that they can do this loan, put 20% down, and as soon as the account's set up, they can wire the other 80% cash that they were going to use because they were going to pay cash for this into that account and have no mortgage payment. She's like, well, that's not the ideal client. I'm like, but you didn't say no. So you got a cash buyer, have them just put 20% down, wire the rest of the money into that account. Now they have an account set up with, let's say, $600,000 that would have just went to the house. Whether they use it or not, it's available until it's not, until 30 years is up. So the other key thing is since it's a bank, What's the FDIC insured limit? $250,000. Dude's $3 million loan is freaking secured. Anything happens to that bank, all $3 million of that, they just send him a deed to this house. It's not only secure, it's more than insured, it's secured. So now you can have a bank account with $3 million in it and not worry about it. So that's cool. So, like I said, any investor, anybody who is good with money, not living paycheck to paycheck, who can put money into this account and manipulate the interest and basically pay off the mortgage in less than 10 years and have access to that if anything happened, right? The whole time. That's what this loan is for. So let's do a simulation here. Okay, let's say we're going to purchase a house. Let's do primary residence. I'll do versus a traditional home. Let's say 500,000. Loan balance, let's say, since it's a primary purchase, let's say 450. 30-year on the comparison. Let's say, let's go 6.5. Let's give them a good rate. Good for 6.5. That's awesome. Extra payments, no. And we're going to go to next. All right. This is the cool part. I like to take them all the way to the nuts and bolts. I said, let's play a game. Let's get rid of all your bank accounts and just operate out of this one. How much income's coming in? All right. Realtors, they're like, couldn't tell you in 90 days, but I can tell you how much this month, right? Let's say there's someone that gets base pay and commission. All right. Let's say their income monthly is $10,000 a month between the two of them. All right. Whoops. Say monthly. All right. One-time deposit. Well, he said, yeah, our base, we get $10,000 a month, but quarterly, I get a $20,000 bonus. All right. Go down here and add repeat deposits. Let's say $20,000. Frequency, quarterly. Okay, let's just go there. Oops. So now, based on that, they're $120,000 a year income coming in, deposited for their salary, and since their quarterly bonus is $20,000 a quarter, they technically have $200,000 a year coming into this account. All right. Now we're looking at taxes. $500,000 home. We're looking at $250. Yeah, $250 a month. Let's say $350 taxes and insurance. All right. Now I'm going to ask them what their monthly expenses are, not the mortgage, right? Because the mortgage is built into this. They're just going to be taking interest out on the 21st of the next month based on what it calculated the month before. So there's no, you don't make any payments. It just pulls interest out of this account. And if this month your interest was $15,000 or $1,500, well, that would be massive. Dude in Utah's got 15 grand coming out for sure. But if it was $1,500 coming out this month, but you had a big commission, next month your interest might be $1,300. What other mortgage does that for you? You didn't even pay extra to the payment. You just got paid more, right? So they tell me it's like, okay, yeah, we have our car payments, we got credit cards, her Nordstrom card is through the roof, so we have to pay $1,500. I know, I'm cheating. I'm taking on the women, right? No, the guy's Bass Pro Shop card's like $2,000 a month. Okay, so let's say out of all that, they're averaging $6,500 in expenses, not counting the mortgage. All right, cars, payments, whatever, utilities, they live a little heavy. But if you have that kind of money, you can't. So they're left over with $7,000 each month. I like to get conservative. They give me a number and I'll throw $1,000 back. I'm like, let's give you $1,000 cushion just to see what happens. Okay? These guys are sitting at 7,000 left over. If I calculate the results versus a 6.5 rate. Okay? If we just did that simulated process, if all that happened was that those are their only expenses, $6,400 a month outside of the mortgage, and that money was guaranteed coming in, right? They would have $450,000 in that account in 4.7 years and no more payment unless they used it, right? Versus the 30-year 6.5. Here's an argument you get. Well, but I'm going to refinance 3 times because you're going to do it for free for the next 5 years. So my rate's eventually going to end up at 5 or 4.5 or whatever. I'm like, yeah, and you start over. You'll probably start over with 30 years every time. So that just totally negates the fact that you just dropped your rate to 4.5 over the next 5 years because you're going to pay the same amount at the end of the day. This, however, we just had this scenario. Guy wants to do his primary, and he wants to start using the money to buy. He wants to buy a DSCR right away. Okay, so let's go back, right? Let's go back to spending. Let's say in 2 years, they're planning on buying their first investment. Let's say it's going to cost them 20% down on a $350,000 condo. So they're going to need $75,000. Future one-time expense. Let's say $75,000. They're going to pull $75,000 out on month 20. Calculate the results. Again, we're still in the simulation, right? They still have the same amount coming in. They didn't put anything extra. They pulled $75,000 out on month 20 and bought an investment home, which we'll say is breaking even, just to not mess with our algorithm here. That rental home's breaking even. They took $75,000 out, and in 5.4 years, it's still paid off. And they used the $75,000. They didn't put it back. They just used it. Let's get a little more crazy. Let's say they buy another one. This time, let's say it's $125,000 that they had to come out of pocket with. Let's say month 38. $6.7 years. Okay? Based on the money they have coming in, they bought, in that 6.7 years, they bought 2 houses. $200,000 they pulled out of this account. And still, 6.7 years later from the day we first funded the loan, they have $450,000 in there. Is that wild?
So instead of a one-time purchase, if down the road you say you buy a car and you have a car payment, and that adds to your monthly,
Yep.
how does that affect it?
In this situation, we can do that. It gets a little dicey here. I would say people with this situation would pay cash for the car. Because it makes zero. Because here, let me show you this other piece. Why isn't?
Wouldn't you pull the money from the 400,000 and pay cash for the car? So
Yeah.
You're not affecting anything else.
Because let's just say,
Because you're going to pay that off much faster than the auto.
we'll show you how fast it with.
Lower interest rate.
Yeah, so we're at 6.7 years. Let's go back to spending. What is that, 66 months, 66? No, let's say 75, one more expense. Let's say you bought a $110,000 freaking heavy duty platinum, whatever. I don't even think that does it anymore at 110,000.
No.
All right. Oops, screwed that up. 38. This is 75. Remember, it was 6.7 months to pay off. We're adding this truck at 110,000. 1.1 year. That's it. So we're looking at 13 payments, 13 months, and the truck's paid off, or the money's back in there that you used to pay for the truck. Who's going to take and put even $40,000 down on a 6% vehicle interest for 7 years when you can pay it off in 1 year?
So I'm still kind of lost, like, where did the original 400,000 come from? That was the loan?
That was the loan amount, right.
The loan? Is it a
So they
mortgage?
purchased this house. It was a $500,000 house.
Yeah,
They're purchasing it, and they're putting 10% down.
okay.
So we created a loan of 450,000. There's nothing in their bank account because that whole 450 went to the purchase. So we're starting at 0 on day one in the account. But based on the 20,000 or the 10,000 coming in and the 20,000 quarterly bonus, that's the money going in, less the expenses we adjusted coming out. So we showed this. Let me go down to here. Is this pay down table, I think? This shows how much, when it says principal paid, that's how much is in the account to use. So we fast forward to month 12, they've already accumulated $83,000. They could use that right then
How did they accumulate it? I'm so.
because their direct deposits are going into the bank account.
Okay, if your income goes down,
Yep.
what happened?
Obviously, if your income goes down, it spreads it out. So we could go in there and say, let's say it went down right after it closed. Or let's say they got their quarterly bonus evaporated.
Yes.
Okay, let's get rid of that. And I can show you probably at least. Let's go repeat deposits. Let's get rid of that one. Remove. Next. 12.2. Yeah. So get rid of the $20,000 quarterly bonus. It's still only taking you 12 years. You bought 2 houses and a car that's as much as a house, almost. Right? This is not for the paycheck to paycheck people. It'll kill them.
Yes.
Because the rates, right now, the worst case scenario rate, we're looking at 8.4%. Right? Who wants an 8.4 adjustable rate right now? Out of all likelihood, where is it going to adjust over the next 5 years? It's going to go down, right? And it's tied to the index. So every time Powell decides that he's had a good day and he's going to cut, or he didn't see his shadow and he's going to cut the rate 25 points, then your rate all of a sudden changed. Not only is money coming in and cutting your interest down, but the rate changed. You didn't have to refi. So every time that happens, your rate's coming down. And ultimately, you can buy the margin down. This guy did like a 7.4, it was 7%. He bought the margin all the way down. So his actual rate was 7 versus 8.4. It was only 2.5 over the index rate. That index rate could get down to 2.5. So he's sitting on a $3 million line of credit with a 5% interest rate in 3 or 4 years. That's a beautiful deal.
How much did it cost them to buy it now?
3 points. So $90,000. But he's going to be using it so much. We talked about it. It's like if you're going to have over $1.5 million out at any given time through the process, you're better off just eating 90 grand right now and saving the money down the road. You'll make it up in 48 months worth of payments. So.
Okay, this loan connected with some bank or with
Exactly. So we had to stop brokering it out for a little while because our banks that we were working with were maxed. Okay, their warehouse lines wouldn't, handle all the loans we were doing. But since then, CMG bought a large bank chain on the East Coast that opened up our access. So now we can do more of these. So they went back out to brokering out to a lot of other banks can use it now. But yeah, it's a bank. You're going to have a debit card. You'll be able to set up ACHs, your direct deposit. You can wire funds. You can write checks. It's just a bank account. And instead of your regular checking account, when you log in, all you see is your checking and savings. You're going to have checking, savings, mortgage, all those tabs. So you'll be able to see what funds are available from your mortgage to use if you need it.
So when you start out, you're at zero. On day one.
Unless it's a refi.
Right,
If it's a
but just
purchase,
say-
you're at zero.
Yeah, if you were just brand new coming into this and saying, okay, I want to diversify, I wanna buy some properties and a new car.
Yeah.
So you start out, get the loan for, so I pick a property, get a loan for 500,000.
Right. And this is without the $20,000 quarterly bonus, but here now we can see how much is available just at month 9. So if you needed money by month 9.
So the money's accumulating over time. You don't
So you
start
see-
out with $3 million.
See what happened here was we were up to 75,000, month 19 we did that purchase, dropped down, okay, now we only have 4,800 in there. But then it starts accumulating again. At any given time, you can throw a big chunk of money in there if you want. If you sell something, move the money in there till you're ready to purchase or whatever. And ideally, you sit there and you talk to financial planners. The amount of money they save, let's go back to here. We're talking about savings of $268,000 in interest, doing it this way in 12.2 years. Versus, so $750,000, $5,000 in interest that you spent versus $1 million on a 30-year loan. And you never had access to that money on the 30-year loan unless you pulled it out with a HELOC or whatever.
So, John, how would that work if there's a client they have 2 cash investment properties?
Mhm.
Then they could do something like this?
They could do it on both
Get
of them.
another one?
Yeah. I would say we'd look at their primary first, because if they have 2 cash investments, they might have a pretty high-end primary.
They do.
So I would say do that first, because also on primary, we're able to loan more. Investments is 70% loan to value, so they can only take out 70%. Primary, depending on the loan amount that we do, can be 80, 85, 90% loan to value. We want to create the biggest credit line with the first one to give them the most available cash. But if they're all the same and they own 2 investments cash and they got a 2% mortgage on their primary,
Yeah.
maybe we go to the investments and throw 2 lines on those. And then they can tap into both bank accounts for expenditures.
Okay, so there would be 2 separate accounts?
Yep.
Okay.
So they just do 2 separate wires. No huge deal. If I'm doing this, and unfortunately you can only have 2, I go out and buy an investment property and use this loan, and all I'm going to do is I'm going to have the rent coming in, pay it off, right? All the expenses come out of that account. It's just that property's working account. So it's accumulating money. I'm not messing with it. Pays itself off in 20 to 25 years. And you have money in there. So.
So this is better than a VA loan too. Because a VA loan, you can't pull money out.
It's better than any loan,
Right.
right? For the right people.
Right.
If I'm a VA loan and I'm taking advantage of the VA because I have no money to put down and I have no savings because I don't save money, it might not be a good option.
Right.
Yeah.
But if I have 20-something thousand in my savings account and I'm going to refi, I'm going to kill that savings account and throw the $20,000 in this account because it's going to save you more than what you would actually make on interest by moving the money into there.
Do you have this account?
Not yet. I'm going to. In fact, Mark, that I just brought into, it's hard to explain to people because they have their head so into rate.
Yes.
They're like, I want a rate. That rate cost you $268,000.
Right.
That was a 6.5.
Yeah, if you owe it 30 years.
If you stuck to that and paid it off in 4 years, your effective interest rate's like 1.8 to 2.5, somewhere in there. Who's giving those out these days? Even if you have a 2.5%, guy, did one and we had a hard time beating it, right? Against a 2.5 versus an 8.5,
Yeah.
right? But when we started kind of digging into his financial situation, we were able to find out he had money going into savings or this or that didn't give us the yield. I'm like, so what if we redirect that money in there? Okay, let's see what happens. Boom, all of a sudden we killed it. We got it paid off in 18 years versus 28. Okay, kind of the whole situation. So he saved more. So it's just getting their mindset shifted from rate to cost. And at the end of the day, when you're focused on cost, you're saving money. If you're focused,
I think most people see this, I'm sorry, John, I
Yeah.
didn't mean to interrupt, but I think most people just look at it like, well, I'm just gonna get this loan at this rate because, well, we're only gonna stay in this house for 5 years.
Mhm.
Yes.
Yep.
You know, we're gonna
Yeah.
stay 5, we're gonna stay 6, and then we're out, we're gonna sell this, we're gonna buy something else at a lower rate, or whatever the
Yeah.
case, but that's a lot of times, I think, the perception.
Right, and a lot of those guys that are looking at, I'm going to buy this one, I'm going to use it to move up to the next one, but they're never going to have enough money. You know, they're always at the minimum down payment.
So you're saying use this rate off, well, but you're saying people that are month to month,
No,
you know, this loan isn't for everybody,
nope.
clearly.
Not at
So
all.
It's the person that
Fixed
got
incomes
some-
are tough unless they make really good choices financially. Let's say they're living in a 30% DTI world and they have fixed income. Absolutely, we're going to talk about this. If they have fixed income and their DTI is at 45%, we are not even going to talk about this. Okay, but there has to be free money somewhere that we can apply to it to get to that 12 or 8. The average of these are paid off in 8.7 years. This thing's been going for 20 years. They've been loaning in this product for over 20 years. Not one has ever defaulted, even during the freaking crash. I think, 2005, 2006, they started loaning. Yeah, not even in the crash did they ever default on one. And the average payoff time was 8.7 years. So,
So can you use it on an investment property as a standalone with the income coming from
Yeah.
investment property?
you got to qualify, right? Right? You got to qualify just like any other loan, but you could set it up just to have that rental pay it off. So, but yeah, I had my lending partner in Arizona that we just brought on. He was a realtor, and I explained this to him 2 times. Okay, he got a great deal on the builder. I think he's like on a 3-2-1 buy down for 2.9% for his first year, or whatever. I'm like, yeah, you got to do that. But when his buy down is up, he's going to do this because now that he got here and he's got his lender hat on and he's diving into this and his understanding, like, I'm going to freaking do this on my house. I'm like, yeah, try to tell you. Like, so even paying that money toward, it's a lower payment, good for him, but he's still wasting money because all that $2,500 a month is going towards interest when it could be going in here.
Say you got that as your primary,
Mhm.
paying that for a while. You could let that become a rental, take that money out and buy yourself a new place, right?
You don't have to take it out. You can leave it in the account. You can go start another loan on that. You can use, he's got $450,000 available. Let's say you want to put 25% down on a property to get a good rate. Let's say you don't want to do that on another property. Let's say you got your account, you like it, but for some reason you don't want to do it on the second one. Pull money out of there, put it on the down payment, and then you got another loan. And then the rent for that house that you're just leaving can go right into that account and pay itself off. So,
So those numbers we're looking at there, that's over the 30-year term, right?
yeah.
I don't have 30 years left to get to 450.
Give me a scenario. Let's work on Patrick's scenario. Let's do this. Let's start a new one. Let's say you're going to refinance your house, right?
The rental.
Okay, the rental. We're going to do you have any equity in it?
Yeah,
Okay.
say, I don't know, 200,000,
Okay. Before we get to there, what's the value on it?
400?
Okay. Loan balance. We're going to say 280.
No, it won't balance.
Yeah, this is how much we can loan on it, though.
Oh, that's what you're gonna loan
Yep, I'll show you the trick here. Investment property, you're going to be at 7.5. Cash out on the best day. Okay. So we're loaning 280, right? And you owe 200. All right. This is what we're going to do. What do you think your monthly deposit is? Just give me a number. Ballpark it.
The monthly deposit.
Average for the
rent?
year. Just average. No, we can add rent, right? So basically, give me a gross number. Doesn't have to be exact. Just throw one out there.
15,000?
15,000 a month then?
Yeah.
Is that including what you would get from rent?
Yeah.
Okay. All right. Monthly. One-time deposit. We're going to put $80,000 because we loaned that much more over what you owe. So that's going in the account. And we're going to say that's on month 2. It takes 60 days to set up the account. So usually I have them wire the money to your account so you have access to it for the first 60 days if you need it. And then once they open the account, you just wire it back. All right, next. Expenses. Let's just leave the taxes and insurance where it's at. What's your monthly expenses out of that $15,000? Don't count the mortgage on the investment because that's coming out of this already. It's all built in. Count your mortgage on your primary if you have one, and any other. Just give me a ballpark monthly expenses.
5,000.
Okay. I just went the wrong way.
Yeah.
I'm gonna give you a little cushion. Let's go to 6,000 in expenses. Okay. There it is. If you're dumping $15,000 in, you got 6,000 in expenses. That investment loan, which we had at $280,000, you'll have in 3.1 years available to use.
Thanks for
You,
taking the next.
you have my link. Go ahead and fill out an application.
I have your app.
We'll get started. We'll get started.
John, do you touch on the fact that like for anybody with like variable income, all that you need is the interest amount that's gonna be pulled on the 21st to be available in the account?
Yeah.
So that like for realtors or for.
They're working on that. They're adding to this calculator. I'd like to be able to play with daily stuff because I want to see, like, we can get dialed in for a strategy. Let's say we get a strategy of none of my every single expense I have, I've moved to the 1st, to where I got one day where all the money comes out, and then I got 29 days where I'm accumulating money versus on the 15th, the 1st, the 8th, or whatever. I'd like to see if there is a strategy to be used there and how it affects the rate. This calculator doesn't give that to us yet. But if we can dial that in, we might even be able to shave 6 months off just making a change in when bills are paid. Because ultimately it calculates every night what's in there, what's not. And if we can manipulate that system to shrink expedite our payoff time, let's use it. So I'm going to ask Patrick, it's like, when are we closing on this loan?
Let's get started.
Because you got 3 years, and if we look at the pay down table, that's how much money you have available. Because remember, we put the 80,000 in there. That's how fast that money's growing. 16 months, you're gonna have 185,000 available. You can go buy a house, another house. So let's say on month 16, you're gonna make another investment purchase. Let's see.
So if I was doing.
Oh
that,
shoot!
making-
Hold on a minute. That was extra expenses in there. I think it didn't count them because it was a little high. All right. So let's say we had month 17. Let's say you use 100,000 of that.
So I'm using that 100,000 as a down payment to purchase another rental, correct? And then is that also gonna be in this all-in-one, or is that gonna be a separate loan?
You could create a DSCR, or you can do an all-in-one. Just depends on what the strategy is.
Right.
Because remember, you can only have two all-in-ones. Maybe this is a condo
Right.
that you just want to do a DSCR on. $3.4 years. Adds 3 months to it. Using that 100,000. Let me go back. Make sure. $15,000 monthly, 80,000 one time. Yeah. Just wanted to make sure. Let's check repeat deposits. Yep. No, that's true.
So you say you can only have only two all-in-one loans at one time, so if you were to pay one off, then you're
Close
back
it.
to-
You'd have to close the
you have to
account.
Close the account, okay.
Yep. That might change now that we've got more banks.
I'm just saying, because if it's set up with all of your banking, checking, savings, mortgage, closing it out,
Yeah.
that's a pain in the
It
ass,
comes
right?
down to risk ratio. Here's another scenario. The guy who got 3 million wanted 3.6 million. It's set to go to 3 million max, but they will give an exception up to 4 million if we're at 60% loan to value. The only reason he didn't get his exception for 3.6 million was because it was a cash out refinance and he was going to end up with $2.4 million just cash. How many alarms does that set off in the financial world that you're just going to hand a briefcase of $2.4 million to a person that says they are going to use it for?
Depends. Are you a politician?
Right. So, we could, like if this was a purchase and he wasn't getting all that money back, we would have easily got that exception. So what brings me that, the reason why they're only doing two is because imagine if you had 4 different accounts with $1 million in each. The risk that you could just go off the deep end, you could go fund a terrorist overnight, right? With $4 million, you could end anybody with $4 million. Well, not anybody, but the risk goes up. That's why they're only like, you can have 2 max. So the potential for bad financial decisions gets immense when you have that much liquid at your
I tend to lean
fingertips.
that way.
Right. It's like I just went terminal. I'm going to spend all $4 million tomorrow. Right?
All on black.
Yeah. So that's why they only do 2. So, reason this is good for you guys to understand is because now you can free up capital for your clients to go buy more homes. That's the goal. And most of your clients don't know anything about this. So if you have people that aren't on set income, that you have a good idea that they're good with their money and they have money to move around, it'd be worth a conversation.
And the effective APR is below 7,
Yeah.
which is
Average effective rate APR over the past, past 5 years, I think, was 3.4 on this.
So without going into grave detail about the one that just closed for Jacob,
Hmm.
right? He could have done a 203K.
Oh, yeah, he could have.
I mean, he should have.
Yep. He could have.
You were his lender.
He didn't ask.
He didn't ask. I had actually had a
Because
guy.
They closed on it and he literally gutted it, so.
I didn't know that. Like if he would have shared that.
Right.
I had a guy call me from Arizona, wanted to get some money out because he already started renovating. I'm like, whoa, I didn't know you were renovating. He's like, yeah, I dumped like $80,000 of my own money. I need another 40. I'm like, well, if we can't do it now because it's gutted. I was like, if we would have done the 203K at the beginning, we wouldn't be having this conversation.
Right.
So,
So as my lender,
mhm.
bring that shit up.
Okay. We'll call that the Patrick principle.
Thank you.
It's now the Patrick principle. I will always ask if they plan on gutting the house because Patrick wants me to ask you. Who's Patrick?
Right.
Don't worry about Patrick. He
But
wants me
how
to ask.
many people actually gut a house? Like, that's very rare.
Yeah. It takes a weird, sick individual to buy a house and gut it and live in it while you're gutting it and doing all that
Yeah.
stuff. Yeah.
I
That's
mean-
what my people did because they have their rental until May.
Yeah.
So they're getting their house right now as we speak.
Yeah. So,
They're
Cool
a different
stuff.
breed.
so think about the 203K and the renovation loan when inventory starts dwindling. Or when you walk somewhere and they're like, ugh, it's like, oh my gosh, we got to get rid of this or that. It's like, okay, we still can. What about a renovation loan? It's like, oh, it sounds complicated. No, it's just an actual loan.
And I'm not putting it all on you, John.
Yeah, I know.
because We should ultimately know about these products as well.
I should ask. You're right.
And
I could ask a
you know,
question.
I'm sitting with them first before, you ever come along, so
Yep.
now I'm more aware of it.
Yep.
I can ask them those questions. In fact, I might even put it on my buyer questionnaire to say, do you plan on tearing this place to pieces
Yeah.
when you close? You
That's
know what I
good.
mean?
Like,
That's-
and you're showing them. Like, you'd have picked up on that right away when you're out showing. It's like, oh, we want to do this, this, and this. Okay, did you talk to John about the 203K? What's that? Ask him.
Right.
Don't even worry, just ask him, and I can break it down for him.
Yeah.
So, but usually on an FHA, I'm working with people with no money. Last thing I think is that they're going to want to
That's true.
renovate their house.
That's legit.
The $1,000 for the consultant,
Mhm.
they're like $1,000.
Right.
That's actually very fair pricing.
Oh, for sure.
I wouldn't do for 1,000.
Because they're basically managing that process. They're going to make sure that the permits are good. They're going to manage the draws, all of that. Because in a construction loan, someone goes out and makes sure the stuff was done in order to trigger the next draw release. So that HUD guy, that's one of his primary reasons, is to make sure that when that draw is ready, that the work was done.
He's like the GC on the lending side.
Yep. So, mind blown?
What about for manufactured homes? Can they still do that for the repairs? Or is it a little more?
Hard money only.
Because I've seen that like
Let's go back.
pretty decent manufactured home price.
Let's look and see if it's on that.
But it needed like some new windows. Needed, like, new
203K.
carpet.
Manufactured? We can do manufactured on the 203K, limited or standard. So it's just like any other house.
Okay.
So it, basically, if it will appraise for what you want to do and the bids are in line, that appraiser's going to sign off on it and we're going to close on it. So if it's carpet, kitchen,
New wheels.
I believe you can add on, you can do an HDU, ADU unit on a FHA if it's attached. Has to be attached.
To this structure.
Yeah,
there.
new rims. Good.
Like chrome rims, I mean, that's 5,000 to 10,000.
Yep. So, I don't think engineering things like strapping on a manufactured home,
It would
I don't
have
think
to
that
already-
can be
it
too.
would have to already be converted to real
That's a
property.
HUD situation, yeah.
And Realty One Group doesn't allow it.
Yes.
Well, no, it doesn't. I mean, there's homes out there that weren't strapped, 80s, 90s, that are just sitting on blocks. Conventional, I can fund that without straps, because as long as it has an adequate support and it has an affidavit of the fixture, meaning that it's affixed to the ground. Well, if it's sitting on block, it's affixed to the ground. The blocks are on the ground.
Yeah.
FHA is the only one that mandates the straps.
What are straps?
They'll go in and make sure it's sitting on blocks, but they'll like
They anchor
drive
it.
these
They
things
anchor it,
deep in the
yeah.
ground, and they'll put a strap over the truss of the, and they'll
So-
strap this to the
so a
ground.
tornado can't take it away.
Exactly. Wind. They don't want these things blowing off the blocks, right?
The wind last night was crazy.
Oh,
over
it's
here.
nuts. So yeah, you're right. It's not a deal. It's not real property unless it's affixed. So that has to be done. It
Because
can't be a
otherwise it has
203K.
a title, you have to go to Secretary of State,
Yeah.
and that's a whole mess. So unless it's been converted or is in the process of being converted and you have the certificate,
And
then.
rule
there
of
is-
thumb: if it's in a mobile home park, stay away from it.
Correct.
You're not gonna be able to sell it. We're not gonna be able to loan on it. If it's on a piece of land, 9 times out of 10 you could sell that. It's affixed.
Because usually they're converted to real property.
Yep.
Usually, not
Yep.
always.
And if they can't find their affidavit, we'll have an engineer go out there. They'll want to do an inspection and see if it's strapped and issue a report, and we're good to go. So there's a lot of things that agents getting. Even when I was an agent, I didn't know a lot of these things, right? So they're like, "Oh, we can't do that," but we can. You actually can. Like single wide, we can loan on those. Conventional FHA, we're good. My other lending company wouldn't. It's called an overlay. Some lending companies will lower their risk ratio by adding an overlay saying, we will not loan on any single wides at all.
Double wides are good.
Double wides are good. Most mortgage companies won't loan on single wides.
When's your next class?
Next class, do we have?
We have a CE class on the 26th that's open for everybody.
Oh yeah,
Saturday.
food and booze. 1 to 4 at Green Valley. We're bringing in lunch, and then we got booze right after for a happy hour in the office. So that'll be cool.
Classes on FHA versus VA and
26, 1 to 4.
3 hours of CE credit.
But I do at Summerlin. I got every first Wednesday from 11 to whatever. So I got to come up with a topic for next class. But I mean, you guys got lunch. I shifted this into a mortgage and mimosa series. We're actually doing it the same class at Southwest and Northwest this month. On the 19th at Southwest, 26th at Northwest. We'll have mimosas and whatever, and we'll go through this. So, and now that we're at a dry January, you might as well come to that one too.
It's right there, we done.
Yeah, goodbye. So,
It was recorded?
yeah. What was that?
It was recorded?
Oh yeah, it's recorded. So it should be on YouTube for you.
Well, I'll see you on.
Hopefully I didn't say anything and come back to haunt me.
Back on 26th for sure.
Okay.
And I just didn't want to bring it. I have like, someone, a potential client who is an influencer, and I